Let's bring in William Lee. William is the Chief Economist at Milken Institute. William, always a pleasure. Thanks very much. I kind of want to get right to this because this hasn't gotten a whole lot of play with everything else going on globally and in the U.S. right now. What happened and what led to the government-backed takeover?
Like every other smaller bank that we see these days, some bad management practices at the bank itself made them much more vulnerable to high interest rates because they were lending mortgages without really being as careful as they used to be in scrutinizing the borrowers. And I think one of the things to keep in mind, Sean, is that while banks are very important for the U.S. economy, they account only for about 29% of capital raised by total businesses in the United States. Although they are very important for small businesses, the small business, maybe 79% of the capital going into small businesses come from banks to expand inventories and to expand.
That information is especially important leading into my next question, because I read a story that I found fascinating that said that basically the wealthy, the 1% and those in that neighborhood are keeping the U.S. economy going right now. And it's the people on the lower end of that totem pole who are getting hurt by the Fed not taking action and lowering interest rates. What about that? Have you heard much about that? And for that equation, does it cause you any concerns?
Yeah, actually, you're raising a very important question about sort of the income distribution in the United States. A lot of the jobs that are created right now are in lower wage sectors. They're leisure and hospitality, the professional services and business services and manufacturing that paid a lot more per job. The growth there for the last 3 months has been almost non-existent. And when you actually look at the jobs being created, they're going to the lower and lower salaries. And because of that, the real income of families in the United States has actually been declining, adjusted for inflation, for the last 4 years. So that means that banks are much more important because banks are lenders to small businesses. They're lenders to people wanting to buy houses and mortgages. And if banks are not able to lend, then we essentially choke off the ability of smaller individuals, smaller businesses, and those who are not so rich to be able to tide themselves over with borrowing.
And William, I'm sure that there are people out there reading these articles, following the stories that saying, look, Republic First brought this on themselves. Didn't they learn anything from 2008, the catastrophe then that just led to the global downturn? So how significant is this, what unfolded in the U.S.? What is that going to do to the U.S. banking industry?
I think it's another lesson for the bank supervisors. Everyone says that, the bank supervisors were not paying attention when the California bank went down, and also the other bank called Republic went down. It was mainly because supervisors were not on top of what's going on in the individual banks and reining in wild managers from doing stuff to try to make money. Now, one of the things that we have to remember is that not all banks are wild banks. In fact, most of the banks, we have almost 4,000 banks in the United States. Almost all of them are well run. But you have a couple of wildcats out there who are just trying their best to just cut corners. And those are the ones that supervisors and regulators have to rein in. And essentially, the Federal Reserve in San Francisco failed with the previous failures, and now we're finding the supervisor in Philadelphia, and by the way, Republic First is a state supervised bank, right? So the onus should have been on the state regulator, and they also fell down on their job in managing and keeping up with what's going on at this bank.
Okay, so let's look at the other side of that coin. What does this do to Fulton Financial? It basically doubles its holdings in Pennsylvania, makes it a player there. Will it be able to do business that it couldn't do yesterday?
One of the quirky things about being a larger bank is that you get closer supervision, and that's a good thing as far as the safety and soundness of the banks are concerned. Fulton has, at least we think, better business practices that won't allow the kind of reckless lending to take place that occurred with Republic First. So we hope that this merger will create strength from weakness, and if they don't, then it's the job of the supervisor and regulators to make sure they do.
Okay, we know the Federal Reserve is going to begin its two-day meeting tomorrow, Tuesday. Now, will this, do you think, work its way into its notes? Will they be talking about this? And certainly no one is expecting any drop in rates right now, so what do we expect?
It'll be a footnote in their discussions because, as I said, most of the capital that's raised for American businesses is coming from the stock market, bond markets, and the capital markets. And 20 to 25% of the funds come from the banking system, and most of those funds come from the very large banks, and those are super managed. J.P. Morgan, Citi, and so on. So I think we don't need to worry about the banking system as a whole. The Federal Reserve will not worry about that either. They're concerned about inflation. If service sector inflation stays at 4%, they're not going to move. And we don't think that the Fed will move until maybe November or December, when they maybe will be able to receive convincing evidence that inflation is on its way down to its 2% target.
Yeah, perhaps not even at the end of the year. It could be 2025. William Lee, always a pleasure, my friend. Thank you so much.
Thanks for having me.